Hello, everybody. This is John Blank, Chief Equity Strategist and Economist at Zacks. And I'm back to doing videos today. And I'm going to start off with an April 22 version. My title today is Big Stocks Do Matter. Big Stocks Do Matter. And we're going to get into basically what I want to point out to large cap stocks, large cap indices in the United States, and large cap companies that are dominant, mega caps particularly, are something you need to keep in mind of when you watch the story of this recession and rate hike cycle go on, because they are the fly in the ointment that is different this time around and will change the dynamics of your thinking and investing. So first off, I'm going to go through some equity rates and macro update, and then I will go a quick deep dive into mega cap stocks. Now, I want to point out that I will often skip slides during this talk. I know this is a video, and you can stop and pause those videos to see these slides. You can also get these slides from us at ZRS, Zacks Research Systems. They will provide information for you at the end of this project and during this video on how to get a hold of these slides directly. So don't worry too much about me skipping stuff. If you like it, talk to us. We'll get it to you. All right. First thing to point out today is that the S&P 500 forward 12-month valuations are compressing down about 20.4 from a high around 24. That is a 20% decline, and that is, helping retain and restore some respectability to the idea that underlying fundamentals matter. However, here we go. Look at the bottom green line. That's the equity risk premium. Used to be around 5. Now it's about 3.7. So that's the other part of the story here, is we really do not have a lot of fundamental upside to this market at these prices. So the only reason to get bullish right now is on a forward look, looking over the worries, not at the worries. Now, the other thing I want to point out here is the story of the Russell 2000. It's the blue line. That's the absolute level of the Russell 2000 index. So what you can see here is back in about the fourth quarter of 2020, it started rising when Biden got elected and continued to rise until he got to his inaugural. And then since then, it's basically gone sideways to some degree down. That's a consolidation period. You can see it's about 5 quarters long. So what's happened here is the story of relative valuations between the Russell and the SPY, the S&P 500, has dramatically improved the story of the small cap stocks by 18.4%. There's a 20% upside in just holding a small cap index over a large cap index relative to history. Now, this is going to get to my point about big stocks do matter. You can flip that logic around and say people still want big stocks more than small cap stocks. And maybe that's because there's a lot more money and cash and dividends and growth in those big stocks. So I'm going to argue that to some degree, partly, that is still the case. These big stocks have come out of this COVID pandemic, and they're still sparkling and earning the money that people are chasing. And that's probably going to diminish a little bit, but not a lot of it. So you've got two plays here. One is to stay with the mega caps. The other is to buy the Russell. My personal view is to do both. I don't know really why not to stay diversified in such an uncertain environment. So where are we in terms of risk off? I mean, you saw that S&P 500 compression. Now let's look at the ARK ETFs. Again, we all know the February high at 21 for these stocks. That was right at the start of vaccination. And vaccination is the story of the COVID pandemic as far as a ameliorative policy. It's the one that works everywhere. So we're not going to get done with vaccinations for a long time. It's going to enter the venue of endemic things like mumps and measles and tetanus, all the other shots we get. I think we're just going to get used to it. So what we see here is that, in the last few weeks, the ARK ETFs did bounce. They actually went down again. But I just want to point out that generally speaking, as long as that risk premium is low and the valuations are high, these stocks are going to get pounded some more. So I don't think the pounding is done for these super growthy names with no profits, but I do think that the game is over for those that make profits. So I think the market will differentiate between tech stocks that make money and those that don't. And this is just part of what the story here is. The euphoria of the new world of the COVID pandemic is long, long over, and we're going back to profitably updating ourselves on stocks. All right, so here's the dividend yield to the 10-year. All you know about the rising 10-year. I just want to point out something interesting that, yes, it has gone down to 0.68 as a ratio, but for the last 2013 to 2021, this is pretty much where it's been before. But I would also point out, it's not this extreme situation like in 2020 where there was a lot of upside to the S&P 500. There's no upside to the S&P 500, but there's also no downside. Point this out, we can't actually go lower on this. Look at 2002 to 2008. This can actually go lower. So keep that in mind. This is not actually a bearish chart. It's just that we're getting back to reality here. All right, Treasury yield curve, we all know the story. It's converging around 2.5%, 3%. You can see those yellow, green, and aqua lines all shooting towards the same place. So what this is telling you is basically the market is now understanding that we are headed to a neutral rate, and they'll price in what that neutral rate is for the next few months, if not years. So 2024 is a real end. I don't think we're done with this rise. You can see that back in 2018, we were at 3 point something before. So I can't imagine us stopping anywhere before then. So we've got a little ways to go here on the Treasury. Okay, and this is the broader U6 Household Unemployment Rate. Keep this in mind. This is the broader one. This is not U3, and it is basically down. So the other thing I want to point out to people as we talk about the mega caps is we are back to a problem we had in 2019 before the COVID pandemic, which is what happens when you're at full employment. And in fact, we just made it worse with all the COVID shutdowns because we took out a lot of supply that has to be redirected. But at the end of the day, dramatic recovery in the unemployment rate. We are at, for all intents and purposes, a full employment. All right, this chart I'm going to have to let you pause and study later. I'm going to talk about this in my economics work next week, and you can get this on Zacks from me. This is a key chart. We got to get through it at some point, but it's a big story of what the Fed is worried about, which is the housing prices. It's a whole story on its own, but keep in mind that this is what really is going to take some thinking to do, and we probably will touch upon it later. All right, COVID pandemic. Basically understand that, outside the United States, particularly in Europe, Germany, France, and the UK, there is actually rising COVID cases. But the more important thing to understand is you do not see the rising hospitalizations because we got also a lot of ameliorative drugs, this thing called Paxlovid, which you can take after you get COVID, which eliminates a lot of the really bad effects. The basic point is the medical world is getting their arms around COVID. And, the caseloads can and will go up at times, and the hospitalizations will not go up. And it's the hospitalizations that cause the shutdowns, not the cases. As long as hospitalizations stay out of the way, we're fine in this thing. Payrolls, keep this in mind, folks. I mean, as we watch the Fed rate hikes, the last 6 months on ADP payrolls around 500,000. Typically, a strong trend, long-term trend economy will do 2 to 250 on this number. So we're double that. We can't do that forever. That is, if you want just a basic framework that's overheated, this is overheated because you're at the bottom doing 500 on a month on payrolls. You can't do that. Got to raise rates, and we're doing that. Gold and silver prices. Everybody likes this stuff. Look, it's been range trading since the COVID pandemic. There was a big risk on or risk off move into gold and silver during the pandemic, and it's basically gone sideways since then. So I don't know anything here other than you and I can tell that it's range trading. We're top of the range. I'd be a seller, not a buyer, just because I think it's range trading. There's nothing else going on here. Iron ore prices and oil. Okay, again, we're going to do a talk later, a couple of weeks from now on oil. I'm going to skip it, but basically keep in mind that we went to a massive low in oil prices, even a negative low during the thing, and then the thing rallied. Now we're at the highs. So we'll talk about this later, but just keep in mind this is the Russia story here with the big spike. But generally, this has been going on for much longer than that, and we'll see if we're at a top or climax right now. in the coming weeks. This is an interesting one. Remember, keep in mind that all the metals are actually going up with oil and gas. It's a story of industrialization and goods production globally that has come out of the pandemic. And I actually don't think this is over for a lot of different reasons. And again, that'll be a talk for later on. All right. So, like I said today, I want to talk about these mega cap stocks. I talked earlier about the huge premium that's being applied to large cap stocks. I do find our modeling systems do kick up returns that are higher for large cap stocks than small cap stock right now. And that tells you the story here that some of these big names are doing incredibly well. However, this is the FANG story, right? And you can see that we've, over the last pandemic, Facebook and Netflix are no longer really driving this market. It's become a four stock story: Apple, Microsoft, Google, and Amazon. And frankly, Microsoft and Apple are pulling ahead. And Google, probably, I wouldn't count them out. I think they'll go up with the others. And Amazon, as you can see, has had an early run in the pandemic and hasn't gone anywhere since. Interesting stories here. Keep in mind that, we've lumped these together for so long that we don't talk about them individually. And I will talk about them individually today. All right. So Megacap, top 20 companies, study of return on assets. Again, you're going to have to take this chart and pause it. It's a pretty noisy one. What I want to point out in top chart one is that in terms of return on assets, you've got a 29 for Apple and a 22 for Google, a 20 for Microsoft. Relative to Walmart and GE, it's just not even close. So there really is an incredible return on assets play for those big three stocks: Apple, Google, and Microsoft. Slide 2, Pfizer, the big drug company. Again, pretty good, 15. Relative to JP Morgan at 1 or Berkshire Hathaway at 3. These big, there's different models, obviously, and different ways of measuring profits. But at the end of the day, one of the things that comes clean is that drug stocks are actually really strong cash earners, and that's what's getting a bid for them lately in this market that's pricing in value and cash. Those stocks. Down at 3, Facebook and Amazon. Facebook actually does pretty well on this. Amazon does actually pretty poorly on this. This, again, speaks mostly to business models, but I would point out down at Amazon that, better than ExxonMobil as a business, and it's a monster business. So all in all, if you're looking for cash, you're looking at that first chart, and that is Apple, Google, and Microsoft. That's the point here. Apple, Google, and Microsoft are your cash plays for return on assets in big tech. All right, the vaunted PEG ratio, price to earnings growth rates. Again, very noisy chart. Keep in mind, you can pause this or get the slides from us. This is the type of chart you want to study closely. And in general, a PEG that gets over 2 is certainly overvalued. PEGs near 1 is probably properly valued, and PEG under 1 is desirable. So the only slide I have that we've talked about today will be Pfizer at 0.5. That's actually highly desirable from a PEG perspective. However, we've got a number of names that are pretty good in light of the earnings they can deliver. Google, Facebook, Baba, Intel, IBM, and Merck all look pretty good in this scenario. So again, we're seeing some plays that you can look for when the market carries both about price and growth. There actually are, like I said earlier, mega cap names at this stage of the market that are valuable, and they will get bid by these big institutions. So keep in mind, again, you don't have to overcomplicate the story of stock picking. People like the respectable big stocks. As long as they're not overvalued, they'll keep running. This is what this stock chart says. All right, dividend yield to the Treasury rate. Again, you're looking for, just actual true value stuff to pay dividends. Where should you go? And surprisingly, not surprisingly, towards the same defensive names that have always appeared. AT&T is out there. ExxonMobil is out there. So keep in mind when you look again, pause this chart, take a look. If you're looking for value, you're actually not going to find it in places like Walmart, Microsoft, Apple, and GE, or Google, as its top chart points out. You have to look further into the fabric of these economies, the people paying cash. Again, this is the story of growth versus income. Some people have mature businesses, don't actually need the cash, and they start paying dividends. And this is the story here. So again, I just want to present some charts to all of you that offer a decisive framework for your allocations to your portfolios when you're looking for names that are just in big names, established companies, stuff that might work in this environment. All right, reinvestment rate. I will go quickly through this, but basic point I want to point out here, look who's at the top of this reinvestment rate. It's Apple. Unbelievable story here. This company has a ton of cash. Keep in mind that Apple, Microsoft, and Google are investing back in their businesses. And this is a story that you can see got very noisy back in the 90s, and it's not noisy at all now. That's your basic point here. If you want to think about the mega caps from the 2000 period to now, just look how different this is. You can see it's jumping all over the place back in there. It's not jumping anywhere. It's just going up. So these folks are in for the long haul. They're going to keep investing in businesses. They have a ton of cash to do it. All right, long-term debt to equity. We'll go again. Pause it if you're interested. Apple, pretty high. They've kept their equity down. They bought a ton of shares here. Repurchasing is big for Apple. And they also actually did issue some debt, taking advantage of low rates. But again, it's just screaming at the amount of cash that's on Apple's balance sheet. A lot of people are just buying Apple because it's cash rich. A lot of other stories here. Pause this if you're interested. I'm going to skip it and go on to the next one, which is value, growth, and momentum style scores over the last 5 years. And this is just telling you, well, our systems, long-term systems, what have been good plays. And I'm going to throw out a few names here in non-tech: Walmart, J&J, and HD. They all look really good over the last 5 years. All did pretty well as stocks. And if you're looking for tech stocks, Intel, Google, Apple, and IBM all actually do pretty well. So again, noisy slide. Pause the chart or get them from us and study it and look for some plays. All right, Zacks Rank over the last 5 years. This is a more short-term thing. Talk to you through some names again. Lo and behold, who pops up again? Apple. But also the oil majors. ExxonMobil does real well. Wells Fargo does well. Coke, Google, Berkshire, and HD. Again, folks, sometimes investing is a lot simpler than you think. Just stick with the big names, and you will probably do a lot better than you think. All right, so all I want to point out here in my last slide is the earnings estimates from the last 20 years. Top right corner, Microsoft. Look at how Microsoft versus J&J, JP Morgan, and everybody else. I'm just going to go over and show you what I'm looking at right over here. Look at Microsoft. Unbelievable turn of events for this stock, and it's going to keep going. And this is the story of these stocks. They just had a great pandemic. Now go to Apple. Same story here. Look at that big curve in Apple stock versus Procter & Gamble and Pfizer. I mean, again, impressive stock, impressive story. However, don't count out stuff like Pfizer. Look at it's going up too. Pfizer actually has done a lot better as a stock. As we pointed out today, Pfizer is actually in a lot better shape than the market actually thinks. I'm not sure why people skip it given the COVID pandemic and the meal eaters we're talking about, but there you go. There's your play. So bottom two, Intel is in there at the gray line, and Merck, they're not as attractive as Apple and Microsoft. That's been the story of all the slides today. Those big names still matter. Big stocks do matter. Keep this in mind. Don't make your life too complicated. All right. Thanks for attending today. That's John Blank, Chief Equity Strategist and Economist at Zacks Professional Services, providing you these insights for Zacks Professional Services. I hope you did like it. And if you're interested in getting our material, like I talked about, pausing for these videos to talk through the site is one solution. The other, far better one, is just to give us a call, 866-794-6065. Send us an email, strategy call at zackspro.com, or get on our website. We also have, toggles to the LinkedIn and Twitter. If you also want to get a hold of us, you can see those monikers here. But again, we do this for you. You can talk to us. We have the capabilities you need to study these stocks better and make your portfolios perform in this environment. So again, 866-794-6065. strategy call at zackspro.com. Those are the information metrics you need. And I hope we hear from you, because otherwise we really can't do these talks without getting you support from you directly. And that's it for me. I hope you enjoyed it. And that's going to be the slideshow for this period. Next time we will do the story of the oil and gas stocks, which are also big after the Ukraine story, but we've got a ways to get there, and we will do it at a later date. So anyways, I'm going to wrap this up and stop my recording. So I hope you enjoyed it.